The current price for Baidu Inc., trading as BIDU on the NASDAQ, is $146.91 USD, representing a massive intraday surge of 16.25 USD, or 12.44% as of this moment on Friday, January 2, 2026. This sharp upward movement is catching many by surprise, especially considering the broader volatility we have seen in the Chinese technology sector recently. While most retail investors using a Fidelity mobile app or checking their Robinhood investments might have viewed Baidu as a stagnant search giant for years, today's price action tells a different story. The market is reacting to a massive structural shift within the company that most people didn't see coming until the official announcement hit the wires. The common expectation for Baidu has long been that it is the Google of China that lost its way, struggling to keep up with the likes of ByteDance or the sheer scale of Alibaba. Investors often looked at the stock as a value trap, a company with decent cash flows but no clear path to explosive growth. However, the reality we are seeing today is that Baidu is effectively shedding its skin to become a vertically integrated infrastructure provider. The massive jump in the Baidu stock price today is specifically tied to the news that the company has officially filed for a separate listing of its AI chip division, Kunlunxin, on the Hong Kong Stock Exchange. This is a move designed to highlight the intrinsic value of its hardware capabilities, which have been buried under the search revenue for too long. If you are looking at your Interactive Brokers platform right now, you can see the volume is significantly higher than the daily average, indicating that institutional players are finally buying into this separation of assets. When we look at the trading volume today, it's clear that this isn't just a retail-driven pump. Institutional activity is heavy, and many are repositioning their Fidelity mutual funds or Fidelity ETFs to account for this new valuation of Baidu's internal chip business. By spinning off Kunlunxin, Baidu is allowing the market to price its AI hardware separately from its advertising business. This is crucial because traditional search advertising is currently under pressure from a cooling Chinese economy, whereas AI infrastructure is seeing a massive influx of capital. Investors who practice self-investing or use investing sites to manage their own capital often overlook how much value is hidden in these subdivisions until a spin-off occurs. This news has even prompted analysts at Jefferies to raise their price target for Baidu to 181 USD, suggesting that today's 12% jump might just be the beginning of a longer recovery. The current market narrative is shifting from a focus on Baidu's search dominance to its role in the global AI hardware supply chain. We often talk about NVIDIA stock when discussing high-end computing, but Baidu has been building its own custom silicon for years to reduce its dependence on foreign chips. As the U.S. continues to tighten export controls, the value of a domestic Chinese AI chip leader like Kunlunxin becomes astronomical. For those of you managing an individual brokerage account or using Fidelity Wealth Management services, it's worth noting that this spin-off is expected to be a global offering. This means it will attract a different class of investors specifically interested in the semiconductor space, which often trades at much higher multiples than the internet services sector. If you are looking at the SoFi trading platform or check your Interactive Brokers stock trading data, you'll see that the sentiment surrounding Baidu is flipping from bearish to cautiously optimistic. The expectation was that Baidu would continue to bleed market share in search, but the reality is that they are successfully transitioning their revenue mix. Their AI cloud segment is already growing at over 20% year over year, and by moving the chip unit to a separate listing, they are cleaning up their balance sheet and making it easier for analysts to value the core business. This is a classic example of uncovering value by breaking apart a conglomerate structure. While everyone is focused on the chip news today, there's a secondary story that is just as important for the long-term outlook of the Baidu stock. Their autonomous driving arm, Apollo Go, is now moving beyond the borders of China. Recent reports indicate that Uber and Lyft have both partnered with Baidu to start testing robo-taxi services in London by early 2026. This is a massive win for Baidu and a direct challenge to Tesla stock and its full self-driving claims. While Tesla often gets all the headlines in the West, Baidu's Apollo Go has already completed over 10 million rides in China. The reality is that Baidu might actually be further along in the commercialization of fully autonomous transport than many of its U.S. counterparts. If you are someone who uses online investing tools or a SoFi robo-advisor to stay diversified, this expansion into Europe represents a major diversification of Baidu's geographic risk. Comment below how many shares of Baidu you currently hold, or if you think the Hong Kong IPO for their chip unit will be a success. It's important to hear how the community is positioning itself during these big shifts in Chinese tech. Looking at the broader macroeconomic picture, Baidu is operating in an environment where the Chinese government is heavily incentivizing domestic tech self-sufficiency. This creates a favorable backdrop for their AI development. When you use Fidelity IRAs or Interactive Brokers fees comparisons to decide where to put your retirement capital, you have to weigh these geopolitical tailwinds against the risks. The risk, of course, is that the core advertising business remains sluggish. In the last quarter, we saw a 7% decline in total revenue, which was largely due to the transition to AI-integrated search. The traditional ads are being replaced by AI-generated answers, and while this is better for the user, it is harder to monetize in the short term. This is the tension between expectation and reality that investors have to navigate. The market expected a quick recovery in search, but the reality is a slow, painful transition to a new business model. However, the growth in the AI cloud segment is starting to bridge that gap. For investors using Robinhood app or SoFi Invest, the appeal of Baidu is now more about its infrastructure than its search bar. Their Ernie bot, which now has hundreds of millions of users, is proof that they can build high-quality software at scale. They're also aggressively cutting costs in their LLM models to win the price war against rivals like Alibaba and Tencent. By making their models more efficient, they are attracting a massive number of developers to their platform. This creates a network effect that is hard for smaller startups to replicate. When you compare Baidu to Apple stock, you see two very different approaches to AI. Apple is focused on the consumer edge, putting AI on your phone, while Baidu is building the back-end infrastructure for entire industries. This makes Baidu a more cyclical but potentially more high-reward play in the AI space. For those who prefer online investment through platforms like Robinhood stock trading or SoFi active investing, it's important to remember that Chinese stocks come with a different set of disclosure rules and regulatory risks. But at a current PE ratio that is still significantly lower than its historical average, many are starting to see the current price as a deep value opportunity. Historically, Baidu has often been the black sheep of the Chinese tech world, frequently misunderstood by Western analysts. They were late to the mobile shift, and they struggled with several leadership changes. But the current CEO, Robin Li, has been remarkably consistent in his focus on AI over the last decade. This long-term commitment is finally starting to pay off as the world moves towards a machine learning-centric economy. For those using Fidelity Brokerage or Interactive Brokers account features to track long-term trends, the technicals on Baidu are starting to look very healthy. We are seeing a breakout above several key resistance levels today, supported by that high volume we discussed earlier. The core business model of Baidu today is essentially a three-legged stool: search advertising, AI cloud and enterprise software, and autonomous mobility. The search is the cash cow that funds the other two, even if it is currently shrinking slightly. The AI cloud is the growth engine, and autonomous mobility is the moonshot that is starting to look like a real business. When you look at investment help articles or investing sites, you often hear about the risk of delisting for Chinese firms. While that threat has subsided somewhat, it remains a background noise that keeps the valuation of stocks like BIDU lower than they would be if they were US-based companies. But for a savvy investor using self-investing strategies, this geopolitical discount is exactly what creates the potential for outsized returns. If we look at the competition, Baidu is arguably in a stronger position than many realize. While companies like Huawei are also building smart driving systems, Baidu's Apollo Go is a dedicated service provider with a massive data advantage from years of public testing. On the chip side, Kunlunxin is already on its third generation of hardware, providing a level of vertical integration that even most U.S. tech firms lack. This is why the Baidu stock price is reacting so violently to the upside today. The market is finally starting to price in the sum of the parts rather than just looking at the consolidated revenue figures. In the coming months, the key catalysts to watch will be the formal approval of the Hong Kong listing and the initial results of the London robotaxi trials. If Baidu can prove that its technology works just as well in the rainy streets of London as it does in Beijing, it will open up a massive global market. This would fundamentally change the narrative from Chinese search engine to global AI powerhouse. For those of you managing your portfolios through Schwab Intelligent Portfolios or SoFi ETFs, this kind of fundamental shift is exactly what leads to long-term